Even before the announcement of the Phase 1 trade deal, there were signs that China may post modestly better than expected real GDP growth for the next quarter or two. Unfortunately, the second half of 2020 may see a settling back into a deceleration pattern. The story is complex, yet may be important to appreciate as we assess the evolving story around future tariff uncertainty and the potential for slower global growth. First, near-term China real GDP growth is all about debt. With some success, China went out of its way in 2019 to limit the damage to its economy from higher U.S. tariffs. We saw improved real GDP growth rests on the massive amounts of new credit that the Chinese authorities pushed into their economic system in 2019 to cushion the slowdown in exports. China has cut the reserve requirement ratio and made other more subtle efforts to ease monetary policy, such as the 25 basis point cut in the central bank's reverse repo rate for October. Cutting the reserve requirement ratio facilitates a ramp up in credit issuance. This is apparent in the BIS data. Just in the first half of 2019 alone, public sector debt rose from 49.8% to 52.4% of GDP, which is also suggestive of a very loose fiscal policy. Household debt has risen from 52.6% to 54.6% of GDP, and corporate debt is up from 152.2% to 154.5%. During the first half of 2019 and so far into the second half, the central bank has eased further. Total debt is now over 260% of GDP. Second, debt stimulus may lose its punch. There is a risk for China that pushing more debt into the economy may be losing some of its stimulatory impact. As debt levels rise across the economy, so do risks, and this is critically felt, especially in the private sector. New investment from the private sector has actually dried up, although investment activity by the public sector remains strong. Another flag is rising inflation. Rising inflation is partly due to the impact of African swine fever and the culling of the hardherg, and not just resulting from stimulatory policies and a weaker currency. Rising inflation can be a sensitive issue in any country, and the central bank may become less willing to add more stimulus as 2020 progresses. And as noted, exports are not growing, even though China has done a reasonably good job of replacing lost U.S. exports with shipments to other countries around the world. There is little monetary or fiscal policy can do to assist with export growth if the overall global growth is slowing. While the Phase 1 deal may help a little, that deal was more about China restarting the purchasing of U.S. agriculture in return for no further hikes in tariffs. This does little for Chinese export growth in 2020. Third, currency stability may yield to depreciation in 2020 if growth falters. Having pushed above the Chinese yuan 7 per U.S. dollar line in the second half of 2019, currency movements have become quite muted. The easing of trade tensions with the Phase 1 deal pushed the Chinese yuan stronger, all the way to 6.99, just below the 7 line. Going forward, there may be asymmetric risk present. The U.S. would prefer China to prevent future currency depreciation. We know that the recent stability of the currency does not appear to have been managed and seems to represent a balance in the market while participants await the next developments regarding tariffs or trade. The improved outlook for economic growth, although created by the easing of monetary policy and pushing debt into the economy, actually helped to stabilize the currency at its weaker levels. Even with the Phase 1 deal, it is not likely that the Chinese authorities would allow much appreciation of the currency below Chinese yuan 7 per U.S. dollar. Rather, they would purchase U.S. dollar securities to maintain a zone of stability, say Chinese yuan 6.95 to 7.05 per U.S. dollar. By contrast, down the road, if economic growth starts to decelerate meaningfully, then market participants may well push the currency toward depreciation. Chinese authorities are much more likely to allow orderly depreciation rather than sell foreign currency holdings while the economy is decelerating. A weaker currency helps exports in terms of global competition, cushioning the deceleration of economic growth. Appreciating the asymmetry may be the key to the pattern for the Chinese yuan in 2020. I'm Blue Putnam, Chief Economist, CME Group.